You're listening to the Wall Street Herald. Welcome to all of our listeners. Our featured company is Aspire Mining Ltd. Aspire Mining Ltd. currently traded shares on the Australian Stock Exchange on ticker AKM. Joining us today to speak a little more about the company is David Paul. He's the managing director at the company. David, thank you for joining us here at the Wall Street Herald.
Thank you very much. Thanks for inviting me.
What led you to the involvement in Mongolia?
It dates back to 2008 when my colleague and partner Neil Lithgow, who's also director and major shareholder, and I were working in Madagascar actually, and we were employing a number of geologists. One in particular who we knew quite well was living in Mongolia and had identified a coal project, a coking coal project in Mongolia. And Neil in particular has a coking coal background and knows that in Mongolia is one of the few places in the world where you can find good quality coking coal. So really it's the scale and the location, the geology, which really drew us there.
What's the geopolitical risk do you see operating in Mongolia?
It's certainly a developing jurisdiction, so rules evolve. It's obviously not a first world jurisdiction, and how they evolve creates a level of uncertainty. But we've been there for now 6 years, so we're quite well adapted to the current regulatory environment, and certainly the political tenor over the last few years has certainly become more international. It has certainly become more recognisable and cognizant of foreign investment as being important in the country and to the country, because it certainly is capital poor and resource rich. So I think with that as a backdrop, we see the general environment in a favourable light. I must say I far prefer working in Mongolia than I would in many African jurisdictions, and certainly in some of the other ex-CIS jurisdictions. It is a democracy, and has a fair degree of involvement from the multilateral banks as well, which gives a degree of security.
Are you currently looking at any other countries for exploration and development?
Not for exploration and development. We are looking. We see that we're in an interesting point in the cycle for coking coal. So, and as I mentioned, there's only a handful of jurisdictions which has good quality coking coal. There's Mongolia, and there is Australia. So, given we're an Australian-based company, we have been looking closely at acquisition opportunities for operating assets in the country, and we've partnered with a consortium, including a private equity fund out of Hong Kong, to fund an appropriate acquisition. We've certainly been involved in a couple of processes. We're hopefully involved in some more, and we're looking for something that matches and fits our what we're looking for, and it makes sense.
How's the progress on the rail line looking? Do you think it'll be completed on time?
We had a huge last month. We had a huge boost by being included on the One Belt, One Road national policy of China. So we now have we're now part of the Silk Railroad. We're one of the 4 rail corridors that's connecting China to the rest of the world. We're what they call the Northern Rail Corridor, because it goes through the northern part of China and up through Mongolia into Russia. So has a tripartite agreement between Russia, Mongolia and China. So that's a huge tick, if you like, for the political context of this, the geopolitical context. Everyone wants to see it happen. It makes us a priority funding project for Asian Infrastructure Investment Bank and some of the other funds that have been established specifically for something like us to build out this the infrastructure for the One Belt, One Road policy. So it's a huge boost. We certainly need to identify more capital between now and the middle of next year, because we need to complete a bankable feasibility study, and we're actively pursuing that at the moment.
What are some challenges you see working on rail lines connecting to both Russia and China?
Operationally, there is a specific challenge, which is the fact that the gauge of the railway is different. So China's standard gauge, Russian gauge. All the rail existing in Mongolia is, at the moment, is Russian gauge. So there has to be a transfer point, particularly for bulk commodities, which you need to deal with at some point, probably on the Chinese-Mongolian border. So that's something you need to think about. Coordinating capacity along lots of individual lines is important. So at the moment, the main trunk line that runs through Mongolia, called the Trans-Mongolian Railway, is at or near capacity. So there are a number of staged expansions which have already been approved and funded to see that increase, but we have to make sure that that's in place to coordinate and reconcile with our needs for freight services on that line as well. So coordination is very important. Coordination up through into Russia is going to be important. The Trans-Siberian Railway is at times very full. So there's just coordinating a piece, a 500 kilometre piece in a 3,000 kilometre corridor and its capacities is going to be, I think, the tricky part.
What other unique challenges has been working in that country with so little development present?
Well, you seem sometimes you're doing things for the first time, and for instance, there is a well-established process for public-private partnerships in Mongolia, but ours was the first rail public-private partnership, as we understand it. So that created novel issues, and also the fact is we're talking about a participant in a nationalised industry, which and so you have to, whatever we do has to be compatible with the existing rail infrastructure. So things like some of the technical parts of the rail design has to be compatible with other items. The rolling stock has to be compatible, but there aren't a well-established list of design principles in Mongolia because they haven't needed to. They just built what they had to build. But now you've got a third party involved like us, so we need to have an agreed set of design parameters and rules and regulations that we have to follow. So that has to be developed over time, and we'll have input in that.
What are you currently working on with respect to UVIT?
Look, at the moment we're really emphasising doing the railway first because it's the lead time for construction of the railway is 5 years, and after about the second year of construction of the railway, we can then look at starting construction development of the Yavut coal mine. So the critical path is rail, and that's why we're focusing our efforts on that. There are still some significant exploration targets inside the Yavut property, which we'd like to target in the near term, and each one of those potentially could add substantial tonnes because we've already shown that the seam structure inside Yavut and the basin itself is very conducive to thick quality coking coal.
How do you see the overall outlook for coal over the next 5 to 10 years?
Yeah, we're looking at a development which will come online in, say, 4 to 5 years' time. So having that view of the medium term, not the short term, is very important to us, and understanding that. What we see now is that certainly we see the bottom of the coking coal market was found around December last year. And the reason why it's been a structural shift back up, and prices have improved about 20%, so quite significant in that time frame. And you can clearly point to why, and it's actually Chinese domestic industrial policy is the reason. They have been very active in curtailing excess production of coal, be it thermal or coking coal, out of either mines that are very small. They're trying to rationalise mines into larger, more economic units. High-cost mines, which were losing substantial amounts of money, have had their capital withdrawn. So there's been mine closures. Our understanding in the reporting we've seen is that 500 million tonnes per annum of coal has been removed from the supply base. Now, most of that's thermal coal, clearly, but there's no doubt that there is a portion of coking coal in that reduction. So what you now find is that the imports of coking coal into into China, have increased about 25% this year. So that's completely opposite to what people would have been thinking. And that's put some pressure on the supply side, which has seen some pressure on price. And that's exactly what the Chinese government was trying to do. They're trying to lift domestic prices as well, so they can stop some of the hemorrhaging of losses in some of the coal mines and integrated steel plants that are there, and try to put it on a more substantive financial footing. And that's what's happening. And we expect that to continue, by the way. We expect that policy to continue. I don't expect it to drive prices exponentially higher, because that's not in the Chinese national interest. And they would certainly look to change their policy if it did. But most analysis says that in the medium term, 5 to 10 years, you're going to need to see coking coal prices above $140 a tonne. They're currently about 100, in order to create the incentive for capital investment. Because without that further capital investment, you will have a significant pop in the prices.
So, David Paul, thank you for joining us here at the Wall Street Herald. We wish you and the company future success.
Thank you very much, Nicholas.
Our featured guest, David Paul, Managing Director at Aspire Mining Ltd. Aspire Mining Ltd. currently trades shares on the Australian Stock Exchange on the ticker AKM.